Hi, this is one of our opening lessons, and we use a company called Roadrunner Delivery Service, opened by the owner, Maria Sanchez. There's 10 basic transactions, and for each transaction, we have at least 2 accounts that are affected. The equal sign is this dark line right here. So your assets are cash, accounts receivable, where you did a job for someone but you're waiting to receive the money, and then they broke down to 3 different types of equipment. Liabilities are our accounts payable, which means it's debts that we're waiting to pay. And owner's equity is capital. That capital could be investments, where you put money or items directly in the business, revenues, where you make your money, expenses, where you pay for your expenses or bills, and withdrawals, where you take money directly out. So for each one, we're going to quickly run through them, and we're going to go through and how they're affected, either a plus or a minus. Both sides of the equal sign scale have to equal at all times. All right, so Maria took $25 from her personal savings, deposited to start a business. What is the business getting? The business is getting $25,000 in cash. How are we getting it? We are directly investing into our business, so we are going up $25,000 in value. Number 2, very similar. She has 2 phones valued at $400 total to now become business equipment. So we're going to add $400 to our office equipment because those phones are now part of the business, and we are also going to add $400 to the investment account as well because it's direct value. She didn't buy them, she didn't earn them, she just has them and transferred them in. Number 3, she issued a check. We always use cash for a check. So what is she getting? She's buying a computer system for $3,000. How is she getting it? She's losing $3,000 in cash. Can you have 2 transactions on one side? Yes, because this is equivalent to 0 change and then 0 change. 4 and 5, I want you to pay attention to the terms that say on account. On account means no cash. It's a transaction where you buy or sell and pay later. So in 4, it says you bought a truck on account for $12,000. So in essence, you walked in, you got a truck, which is going to be delivery equipment for $12,000, and you're not paying cash, you're taking out a loan, which is going to be accounts payable of $12,000. How do we know it goes up? It has to go up to make it equal. So plus $12,000 balanced on each side. Why is a bad thing going up? Because you're adding to the amount of debt. 5. Roadrunner sold delivery services on account. Roadrunner did their job, which is called revenue. So plus $200 in revenue for their sales, and they are going to normally get cash, but in this case they're not, so we're adding $200 to the accounts receivable. Mary Johnson will pay us later on at a time. 6, we are writing a partial payment based on this truck. So we already have the truck. We're not getting new delivery equipment, but we're writing a check, a payment. So it's number 6 automatically goes down in cash, minus $350. Minus $350. And we're decreasing our debt. Think of this as a credit card bill. You owe a $12,000 loan. Now I'm paying $350 a month, and now I owe $11,650 left. Number 7, Roadrunner received and deposited the check from Mary. So Mary, remember we did our job, she owed us $200, and now she's paying us. So what are we getting? We're getting $200 in cash. How are we getting it? Taking away from her balance, and now she owes us nothing. 8, 9, and 10 all have to do with cash and capital. 8 received a check, so we're getting $1,200. You stop right there. And how are we getting it? From a customer for a delivery service that was completed that day. So unlike Mary Johnson, who owed us money later, they are paying us right now, which increases the value of our company, again due to revenues. We did a job and we got paid. 9, we pay the rent. We have expenses, they always occur. So Roadrunner wrote a check for $700. So we minus $700. And how are we spending this money? On an expense, which is not accounts payable. It's just a monthly expense. So the value of our company is going down for our rent. And the last one, remember, a lot of business owners don't get a paycheck, but they do have the right to take money out of their company whenever they need it. This is the opposite of an investment. An investment, you put put money in when you want to. In this case, it says the owner is withdrawing $500 from the business for personal use. So the business, which is always what we look at, is losing $500, and the value of the company is going down for what's called a drawing for $500. And then what we do is we add them all up. We add up all the balance of our assets, and what's left, we add up our debts, and we add up our capital or owner's equity, and the equation should balance. I hope this is a good help, a good intro for you. We'll be discussing more lessons to come.